Hey everybody, how are you everyone? This is Jose. We are ready to get started. I was having a little delay on my end, and normally at this time I would have asked you already to say hi on the chat box, so I know that you hear my sound and all of it. So I just got a few, let's call it 1 minute of delay. So if you could just comment on that, just a quick hello on the chat box so I know you hear me well, which should be the case. Then we begin. So thank you for that, guys. Um, yeah. So anyway, welcome to the session. This is Options with Options, June 9, 2022. My name is Jose Blasco. I said that already. We are ready to begin. Disclaimers on the upper left side of the screen. Please read this carefully. This is important information. As always, this disclaimer is obviously critical. That's why it's there. And it's fairly short, so I'm counting on you to read it completely. Thank you so much. Mark, how are you? It's good to see you, my friend. Good to see you, everyone. Perfect. Okay, so agenda for today, as always, we're gonna first start and look at the market, understand what's happening out there. From there, we will look at managing the trades that we have currently running, and from there, we'll look at new trades that may be available, waiting for us out there in the market, and we'll put the right option strategy around them to execute them. During the whole session, make sure you are interactive with me. Feel free to interact, feel free to ask questions. No one is allowed to be shy. So please work with me on that. And if you're watching this recorded and you have questions, the way to ask questions, if you're watching this recorded, is to come to this page, which is tradewithufos.com/Jose. And when you come in here, you scroll down. There are multiple sections here. But when you scroll down a bit more, now you get to the section with the questions. Okay. And here you can search for answers or click on the green button to pose your question, and that way we can support you, and that way everybody's happy. So that is the plan. How are you, Jeff? It's good to see you, my friend. Very nice to see you. And let's now say hi to the S&P, which is falling, and may give us a change of climate today. We'll see. We'll talk about it in a moment. Okay, but today, just like I did in the prior session, I would like to start looking at the VIX. This is how I'm going to start the market analysis, because I have a very short comment to make, which is very similar to what we had last week. Last week, the VIX was somewhere in the middle, somewhere here. So we talked about it's okay for us to be buyers of options, sellers of options. At this moment in time, the VIX is not only lower, it's actually inside green UFOs. So we would expect volatility to come higher. And in that sense, I would rather be a buyer of options than a seller of options. Okay, but this, of course, would depend on the other conditions that we find when we see the rest of information available coming from the S&P, which I'm charting now. So, first of all, what a boring climate, isn't it? Look at that. So many blue dots in a row, where all of those blue dots are thin dots. None of them is thick. They're all thin. And that represents unconfirmed climate. Not this button here. So unconfirmed climates, you can basically see that means the market is going nowhere. Okay, and we're not surprised, and we kind of talked about it the other week, that we have blue color here, even though it's not confirmed, but it's still blue color, right? But on the other hand, the gray line is above the blue line, meaning that the implied volatility of the puts is winning, meaning that there is plenty of buyers of puts, there are many sellers of calls, and therefore there are sellers in the market. And having sellers in the market, basically what we can see here is a little bit of a fight between the ones that buy aggressively, just to find that someone is now selling aggressively against those trades, and the market is just ranging. Okay, so we certainly need to wait for this to define itself. We got two indications of an Elliott wave turning point to the downside. Implied volatility for the puts is greater than the call. So if this climate changes to red, especially if it's going to be a red and thick dot, so then I guess I'm going to change the background of my video stream like I did last time, and I'm going to make it red, okay? Because that would be a very bearish thing to do, to happen. Having said that, we need it to happen. It hasn't happened yet. The price is now trading below the EMA, so you may think, oh, that's it, it's falling. Well, the other day we were below the EMA, and look at what a strong day. So again, there is a big fight going on right now, and anticipating too much what's going to happen, maybe the recipe to be slapped on the face. So let's do what we always do. Let's wait for our rules to be met. And in the meantime, if the rules are not being met, we cannot be aggressively directional in one direction or another, but we can exploit other option strategies such as non-directional trading. This is the beauty of options. You don't need to be stuck in any position because you can build trades that are adapted to what the market has to offer. Okay, so from a directional point of view, it's looking like we're going to have a down climate soon, and with the gray line above the blue, implied volatility of the puts greater than the implied volatility of the calls, that's very bearish, and we're going to go and look for bearish opportunities, but this hasn't happened yet. So far what we have is a non-confirmed climate with levels of volatility which are relatively low, and therefore my choice, if I had nothing in my portfolio, then my choice would be to do double calendars like what I've done last week. Now, notice I said if I had nothing in my portfolio, and for the ones of you that attend the sessions all the time, you know exactly what I mean. For the ones of you that may be new to the sessions or watch this recorded, you may not know exactly what I mean. So what I mean is, it's not the same that you have a portfolio where you have multiple trades running already, and maybe adding more trades is taking too much risk, or maybe you have very few directional trades, but you already have accumulated too many of the non-directional trades during those very boring days. And now getting into another non-directional trade basically is the recipe to get in trouble, because if the market moves from ranging to now being very aggressively directional, some of those non-directional trades may suffer. So you don't want to overload your account with too many positive deltas, too many negative deltas, too many positive vegas, too many negative vegas, too many positive thetas, too many negative thetas. You want to keep a portfolio which is well balanced based on your trading plan rules. Okay, that's why I meant depending on what else you have on your portfolio. My assumption when we run the sessions is always the same. I am always kind of assuming that we got nothing in the portfolio. So if I got nothing, what would I build, right? So in that sense, what would you build is double calendars, given my market analysis, my conclusion, my own trading rules, my own preferences. So that would be the direction in which I would move. Okay. Cool. Okay, so now that we know more about the market, and I'd love to get some confirmation from you guys, if you could confirm that you followed me, that what I just said, what I just explained is making sense to you, and it's all understood. So then great. And I would love to get a little bit of a confirmation on the chat box. A little bit of a confirmation means you don't need to write anything long, just a quick okay, or all good, or all understood, or something of that sort would help me very much to know you are with me. My intention, as I get those confirmations from you, is to now move into the positions, which is the set of trades that we have running in our account, and we are going to talk about trade management. Okay. So thank you so much, Jeff. Jose, Joe, sorry, the balance approach to trades is very satisfying. Thank you so much. Balance is such a key word in life and, of course, in trading, isn't it? And Mark also got it. Thank you so much, guys. Thank you so much for those confirmations. Believe me, it means a lot. Sometimes it's kind of, you're like, yes, I know, I'm following you, Jose. I don't need to say it, but at the same time, it makes a big difference on my end. So thanks for that. So let's begin with reviewing Verizon. Okay, let's begin with reviewing Verizon, and let's talk about what Verizon has done, what we expect it to do, etc., etc. Okay, so when we enter Verizon, it was on that particular date. Okay, and we expected Verizon to get to this target, which was missed by just a few cents yesterday. Okay, so we are very close to there. We were approaching the target. My comment was probably we're gonna get some sort of a retracement to the EMA to get a continuation. Why? Because this climate was very exaggerated on many levels, both from a max distance point of view. We were surpassing one. We actually hit 146, okay, which is much more than one. And from a duration point of view, 17 out of 4. I mean, this is really outside what probabilities would suggest. And I mean, this is the beauty of probabilities, that probabilities are there to be a reference guide. Of course, they don't guarantee the future, right? So, but anyway, they help us a lot. So based on that very stretched probability condition, I was expecting some retracement to then have another push. I was expecting actually that during that retracement we would have a change of climate, so the next push could be more intense and more, if you wish, more stable, more leading to more continuity. Now, unfortunately, we didn't get that, so I'm a bit unsure about the quality of that push. And especially now that we went again, there was a moment in time where the blue was above the gray, but now again we are back with the gray above the blue. And on top of that, they are now expanding, meaning that there are sellers coming in aggressively, and we also saw the S&P, which may be soon aggressively turning down. So what do I have here with this trade? Well, if you recall, after multiple tweaks, the trades that we have with Verizon is a bull call spread where we are short the 55 call and we are long the 52.5 call. And this is a trade that I'm going to graph in a moment. We cannot lose on this trade. Okay, we cannot lose. Worst case is to make some profit. And if we were to get to 55 or above, now we make the maximum profit, which is where our short strike is. Okay, but again, the problem is that now with this even more extended market condition, this more extended gray line, and the conditions that we saw a moment ago in the S&P, I'm feeling that maybe we're not going to get to 55. And it's not a problem because, again, this trade cannot lose anymore. So you can just leave it alone and it's fine enough. But at the same time, I would like to explore if maybe there is something that we can do that could give this trade a little bit better performance. And in that sense, I'm going to get my risk graph and do some additional analysis and see. And so I'm bringing my risk graph for Verizon. Here we go. And when looking at the risk graph, first of all, you probably recall that I got so many, so many rows here with so many options. We only have two, right? We only have two. We only have, the long 52.5 call and the short 55 call. So first thing I'd like to do here is to, you know, do a little bit of cleanup. Okay, I didn't do it last time because I was giving you all the detail of the trades, but in order to convert this into something else, it would be useful to do a little bit of cleanup. And in that sense, it's going to be a bit manual if you wish, but I can do it easily. So, if I look at the options that I sold and the options that I bought, which are those units here, okay? So I got 82, and that one was bought at 30, right? So 82 minus 30, that was 52 cents of credit. And then we got 32 that was sold at 15. So 32 was sold at 15. So that was 17. 17 minus the 52 I got before, that was 35 cents of profit times 2. So I got 70 cents of profit, okay? 70 cents of profit from the initial trades that I closed, which were those, okay? And that left me with this particular strategy where now I paid 58 and received 24. So if I got 58 and I got paid 24, that means that this particular spread, okay, this particular spread cost me 34. So the most I can lose is 34, right? But I made 70 already, so the most I can lose is 36, which is what we got there. Okay, this is what we got there. Okay, so I'm just redoing the math so you understand what is it that we got earlier, and now I'm going to simplify with 2 rows only. Okay, which basically is going to be, let's do it this way. So if 36, it's going to be the credit, right? So what I'm going to do is I'm just going to do the following. So 36, wait a moment, we got 58 minus 24, so that is, but again, 58 minus 24, so this is what we have on the screen right now, so that's 34. So if I want to go from 34 to minus 36, okay, I need to add 70 as I done, correct. So then I'm going to have to add 70 to that 24, and therefore that 24 is going to become 94. And if I did the math correctly, this is going to create a credit of 36. Exactly. So now I got only 2 lines to represent, the whole thing I had earlier with, I think it was like 6 or 8 rows. Okay. So now I can compare spreads, right? And as I compare spreads, now I can copy my primary and evaluate if there is something I can do to my primary that will bring me to a better place. Okay. So again, what's my concern? My concern is Verizon may fall. If Verizon may fall, what's the issue? Well, the issue is that you're going to lose P&L, knowing that worst case is that you're gonna make 36. So again, it's not a problem. But what if I could raise that 36 line to a higher value? Okay. Well, if I could do that, that would be a nice thing to do, right? It would be a nice thing to do because now if I'm right and Verizon ends up falling, so now I'm gonna make more instead of just basically being happy with $36, which again, nothing wrong with that approach because you are basically happy to make 36 in exchange to maybe instead of 36 make 286. So that's not a bad one. Um, but at the same time, the probability of making 286 now, based on my analysis, is less. So then what can we do? Okay. Well, you have seen millions of times that many times one way on how to help our trades is to butterfly them. And in this sense, it's not going to be, in this case, it's not going to be different. So we are dealing with a situation where we are short the 55 call and we are long the 52 and a half call. So what if I was to go ahead and buy the 57 and a half call, which I don't have yet, and sell another of the 55? Well, if I was to do that, then I would have two 55s in the middle, one 57 and a half above, one 52 and a half below. And guess what? That, my friends, is a butterfly. It's a call butterfly, which would still be a trade that make money when the market rallies. But at the same time, by selling that 55 call, I'm going to be bringing in more premium, which is likely going to make my minimum $36 to be more than that. So let's take a look. I'm going to add two more legs at the midpoint, where one will consist of selling another of the 55 and at the current price, and the next one will consist of buying the 57 and a half. And if I do that, so here's going to be my butterfly, and let's take a look at what we've got, which ended up being disappointing. Interesting. I guess that volatility really has dropped a lot. Yeah, because the 55 call only pays us 13 cents. So 13 minus 6, the difference, which is very little, is the extra premium, making the worst case scenario for the trade to be making $43 versus making $36. So we are increasing our performance by $6, which you're gonna pay more on commissions that. So then I would just leave it alone. I was expecting, to be honest, that 55 call would have had a little bit more juice in it, and therefore this orange line, I'm going to use yellow color. This orange line, which is slightly above the blue, would ended up being much higher, and being much higher. So imagine if we got a triangle like this, okay, which is okay. If you go higher and you go to 55, okay, so you're gonna make, let's call it 150. You may not make 286, you're gonna make 150, which is double the P&L we have now, which is okay. But now if it goes against, instead of making 36, you're gonna make 80 something, which is the current P&L. So it's kind of locking the current P&L in exchange for maybe you double it. So that would have been a nice approach, but the problem here is that the 55 call is really having very little premium, and therefore this particular action doesn't make sense unless Verizon rallies again. And therefore, in that sense, the two choices we would have left for us is either to be happy with that 36 minimum profit in exchange for that potential $286 profit, or close the trade now and exit with a net $84 of profit, as you can see here. That would be your net profit if you were to exit now. Okay. Well, I will not. Okay, because I don't have anything else in my portfolio which is long. So if the market is gonna push, I would like to benefit from it. And since I cannot lose money on this trade, I'm just gonna leave it alone. I would have preferred to do this conversion, but it's not worth it, as we can all see. So this is my comments when it comes to Verizon. I'd love to get some confirmation or questions from you on the chat box. This is the time to do it. I'm just pasting here the simplified version of the trade. Of course, the P&Ls are the same because it's the same trade, but it's a simplified version. So that way, for future sessions, it's easier to understand. Anyway, you guys, let me know how is it going with Verizon. And the next trade for us to talk about is MasterCard. Okay, so let's go ahead and take a look at MasterCard, which that one Sorry, not MS, MasterCard MA. Here we go. So, a very powerful drop on MasterCard today. Okay, hopefully that stock is gonna finally change from a blue to a red climate, and it's gonna start falling and hopefully come close to our entry. That stock, if you recall, we entered around 330 and went against us all the way in a major way. It's really impressive on how efficient it was and moving against us. So what did we do in this trade? Well, what we did, if you recall, we started this trade as a bear call spread. Okay. And then what we did is we took this trade and we created a condor version of it. Okay. If you recall, if I graph it, okay, we created a condor version of it. Okay. Where obviously right now we are producing $158, $159 of negative P&L because that stock is still very far away from where we need it to be. But if the stock was to fall, we're going to end up in a profit zone. Okay, so we need the stock to fall around 330 or below, 332 and a half or below for us to start having some profit here. Okay, so we need that to happen. In the meantime, the conversion we did going from better call spread into an iron condor allowed for the risk to be diminished. And we now know the worst case scenario for this trade is to lose 185 per contract, which is pretty nice given the initial risk. But really, when it comes to management of the trade or other things that we could do, there's not too much we can do at this moment in time. Okay, all those options, especially the ones which are in pain, the calls, they are deep in the money, being the 330 and the 335 strike, where the current price of the stock is trading at 355. So we are in a position where it's all about waiting. And again, if in the end I'm right and the S&P collapses and everything else, so this trade hopefully will basically go back to flat or maybe even give some P&L. We do need a significant loss for that because that stock has proven to be very strong, even though it belongs to a group which is weak. That stock has proven to be very strong. So from a trend management point of view, this is one other element of your portfolio if you happen to have it and it's doing its thing. Like all trades that we execute, and they have two options, which is end up as a profit, end up as a loss. This one it's not looking good to end up as a profit. It's much more looking like it will end up as a loss. But you never know, if the market could fall very hard very quick, and next thing you know, you are back in business. And we acted on the options to mitigate the risk as much as possible. June 17 is approaching quick, so if the market falls, the time decay is going to act very nicely, and we should see those problematic this current problematic P&L to be erased very quickly and go flat. But we need a drop. Okay, if we don't have a drop, that's it. So this trade will end up with a $180, $185 of risk, in this case loss per contract. And the last trade I have in the portfolio would like to comment, and this one we need to act on it. It's Delta Airlines. So Delta Airlines is a trade that we executed last week. And again, please guys, if you don't mind, I'd love if you could give me some confirmation about all understood when it comes to what I just explained, both related to Verizon and MasterCard. And now we are moving into Delta Airlines, which is a trade that we entered last week on this very specific day, to be precise, which is a double calendar using the 43 strikes and the 33 strikes. Okay, 43 for the calls, 36 for the puts, and that stock is doing what it's doing. And while the stock is doing what it's doing, guess what? The front week expiration options are about to expire tomorrow, and therefore we may be dealing with what we call distorted Greeks. Okay, and therefore it's going to be time to roll. Okay, so this is the position we have. Currently, this position is showing a negative P&L of negative 16, which is totally normal in the beginning of the life of these trades. Remember, this is a volatility play using the expiration date, which lines up well with earnings. And while we are waiting for that to happen, the shorter term expiration, in this case, the one that expires in June 10, which is tomorrow, are going to be the ones that we keep rolling and rolling and rolling. Okay, so notice how the June 10 call has a bid of 0 and an ask of 1. And the June 10 put has a bid of 7 and an ask of 9. So they must be ready to be rolled. Okay, so let's load the option chain so we can evaluate this much better. So we are dealing with June 10. I want to see what's happening on the next week, which is June 17. And we are looking at the strikes 36 and 43. Everything else is not relevant to me. So what do we have? Well, again, let's begin with June 10. Okay, so we have 1 day to expiration. Okay, we have 1 day to expiration. The theta of the 43 call shows as not being able to be calculated given the fact that there is no bid. So that is definitely distorted. And the 36 put, which has bid and ask, okay, and therefore can be calculated, shows a theta value of $13. Okay, so we are supposed to make $13 in 1 day, but that's impossible because the most we can make is anywhere between 7 to 9. So the theta is distorted as well, and therefore both the calls and the puts are to be rolled. If we roll the put, the 36 put, into the next expiration date, which is June 17, 8 days to expiration, so we are going to collect 50 cents, okay, diminishing the risk of the trade by 50. So in other words, the current P&L of negative 16 is kind of like you add $50 to that, and now the P&L becomes positive. I mean, it will become positive next Friday when the options expire. But we are acting on those rolls to bring in premium in, to lower the cost, and therefore diminish, ideally remove the risk in a few weeks' time. Now, the issue I have is with the 43 call on the June 17 expiration date that has extremely little premium, and basically selling that option, it's kind of like a waste of time if you do it now. So I would like to consult, what if instead, for the call only, because the put is fine with the 50 cents, but what if I was to look at June 24? So if I look at June 24, what do I get? I get 11 cents, which is also very, very little. Okay, so the action that we're going to take here, as we have done in prior sessions in the past, is we are not going to roll the call, because rolling the call means that you need to pay commissions to get out, you need to pay commissions to get in, and if you're only going to get 5 cents and you have to leave 1 or 2 cents on the table and you have to pay commission, then you are left with an option which is like 2 or 3 cents. And then when you sell it, then you need to pay commission, and then when you roll it, you have to pay commission. So basically, you're working for the broker and for the exchanges. You are not working for your account. So in that sense, what we're going to do is that we're going to leave it alone so it expires, and then we will place an order to be executed on Monday, where that order will be a good till cancel order to sell this 43 call at 15 cents. So if we get 15 cents or more, we'll get filled automatically, and if not, then we will reassess that at the end of next week when we meet again to see what to do. Okay, but we don't want to sell this for 5 cents, because again, when you add commissions and rolls, then you got nothing. Okay, so let's work on the put side when it comes to rolling. Okay, let's work on the put side when it comes to rolling. I'm bringing TOS here. So we got June 10 put, right click, analyze, create a rolling order. Here we go. So we're going to be doing 36 put, moving from 10 of June to 17 of June, and that's going to bring in 48 cents of credit net. So I'm just going to confirm and send. Okay, and as I send this, the order is here waiting to get filled. Let's see if we get the field quickly. I'm just going to try to request 1 cent less to see if I get it like that. Okay, normally those actions of trying to negotiate your entry prices should be done with no rush. As you know, when I do this in the sessions, I push it. I actually often use market orders, which is a big no-no. I'm just saying this for the ones of you who are not usual attendees or watching this recorded. Never use market orders, even though you may see me do it because I want to push this to be executed. I'm just going to do it. So that way I can have it in the system and I can comment on those trades in the future sessions. But with the market order, you may get slippage and very undesirable prices. So don't do it, okay? Even though I'm doing it, okay? So I just got filled at 42. Okay, great. So I'm sure that in the real world you can do it with a bit of patience. You can get a better price, okay? But I got 51, I got 0.9. So let's go ahead and add this to what we currently have. Okay, let's add these to what we currently have. Let's compare. Okay, let's copy the primary. Okay, and now we're gonna add it. And what's happening here with the put here, the June 10 put, is that this June 10 put, now is moved to June 17. Okay, now this put paid me 27 cents when we did it originally. Okay, this put paid 27 cents when we did it originally. To get out of this put, we had to pay 9, and then we collected 51 from the new put that expires next week. So, in other words, 57 minus 9 plus 51, this is a net uh, credit out of utilizing two options. Okay, one expiring on June 10, one expiring on June 17. So this is a net credit of 69 cents, and therefore I'm going to add here 0.69, which that will emulate the new trade I have here. Okay, so you can see it here. Okay, so now we took the risk of 211. So the most you can lose is 211, and now that risk is now 169. Why? Because we added 42, okay, which is the difference between these values. Okay, so now of course when you look at here, you still see June 10, right? So if this June 10, okay, if we achieve the goal of moving that June 10 43 call to June 17, and we manage to sell it at 15 cents, so that means that, on top of those initial 22 cents I collected, okay, on top of those 22 cents, I'm gonna add 15 more, which is gonna make this to be 37. Oh, now this depends on me getting filled on Monday or after Monday at 15 cents for the 43 call. If that was the case, so this would be the new risk profile, where you can see now our risk moved from 211 to 154. We have a similar distribution and a very similar effect when volatility rises. You can see how the green zone expands. Okay, and the volatility rise is expected to happen as we are getting closer to the earnings date. So that's the thinking, that's the strategy, that's the management. These are the actions that we are taking. Let me see, Jeff. Put the 43 call on GTC. Yes, correct. I'm gonna do that. I'm gonna execute that one now, Jeff. So you see me do it as well. And Joe, I rolled on Tuesday morning. My max loss is now 175. Very good, perfect. As long as you did it when the Greeks were distorted, that's perfect. Okay. Of course, if the market falls more, right? So what's going to happen? Well, the more the market falls, the more the put is going to pay you. If the market rallies more, the more the market rallies, the more the call is going to pay you. So you may be in a position where you were maybe a bit more in the middle, and then you got a bit less from the put compared to me. But we don't know the future. So as long as you did it when the Greeks were distorted, basically you maximize the accumulation of time decay at that moment in time, and then doing the roll is great. Because also, by the way, in my case, it showed as 154, but hey, that is only if I managed to get additional 15 cents for the 43 call, which that is something that I may or may not get starting next Monday. So I'm going to put it here just for the simulation so you understand, but I may need to remove that. Okay, I may need to remove that. The bid on the call was 2. I get you. So then when that's the case, we just leave it alone, we let it expire, and this is what we do. Okay, so for the 43 call that expires in June 10, we still have a -1 unit here. We are short one. I'm going to leave it alone. No need to add a closing order. Okay, no need to add a closing order. What we're going to do is we're going to add using June 17. We're going to add an order to sell the 43 call. But of course, right now it's trading at 4 cents. We don't want that. We want 15 cents. Okay, now this obviously is something that we're not going to get unless we are patient. So in order to be patient, we're going to use a good till cancel order. And by the way, we don't want this to be activated until Monday or after, because what if the market was to rally very hard in the following days? Well, if the market was to rally very hard in the following days, you would get 15, and next thing you know, now you are short 2 calls. And what if you get a sign on one while you're short another one? That's a big problem. You now increase your risk by a lot. So we don't want that 15 cents order to sell the call to be triggered until Monday. Okay, so how do we do that? Simple. We're just going to act a submit condition based on date, which is, hey, Monday, which is Monday 13. Okay, when the market opens, which is 9:30, and I always, give it a little bit of extra room. I'm just making up 33, but you get my point. So just so typically at the open there may be slippage, there may be lack of price stability. So you wait just in this case 3 minutes, and then the order is being sent. And because it's going to be sent as a good till cancel, it will remain alive during the whole week. So anytime during the week where we got 15 cents or more, we'll get filled. And if we don't get 15 cents, well, it's not ideal, but it's better than getting less than 15 cents, because you didn't pay commissions either to get in, and you don't have to pay commissions to roll it out. Okay, so in the end, it's kind of like the same. So then I'm going to place the order, knowing that that order now is going to be just waiting, because it's not going to be triggered until Monday. Okay, so this is how you do it. I believe, Joe, you probably wanted to see this, or maybe you have done it and now you are confirming or reconfirming that what you've done is the same as me. And if that all of this is the case, then it's great. If you have any question, Jeff, or anyone, of course, no need to say, please comment, ask, type, so I can help you better. Joe, and I was afraid of an up move and the put premium would diminish. I get you. I get you. Yeah. Bottom line, it's all about acting based on rules. And when you say I was afraid, I mean, I understand this is how we say things in English language, which I often pay a lot of attention to it because it's not my first language. Sometimes I overanalyze the words a little bit, but I know you don't mean that you were afraid, like you're at home and you're shaking, right? So it's not the case. But at the same time, really the best way to avoid trading emotions, to not to even feel or think you are afraid. What if this happens? What if that happens? Well, instead of thinking about what if scenarios that may be problematic, just think about what are your rules. And if your rule is when you got the Greeks to be distorted, you take action. So then you don't need to think, you don't need to feel afraid, you don't need to, wonder about what if the stock does this, what if the stock goes that. I mean, of course, in the back of our mind, it makes a lot of sense. But as you get used to the processes and you get used to trade, and by the way, many of you are quite experienced. Okay, so what I'm saying is something you do already, but basically all of this becomes second nature, and those psychological thoughts, if they happen to happen, you recognize them and you ignore them. Okay, so that's basically how we act. Okay, so and I'm sure that was your process. Joe, I ignore my sense of greed. Well, here we go. I just used the word ignored, and that's exactly what you did with a trading emotion, in this case, the greed. So perfectly done. I love it. I'm actually delighted to see you guys doing what you're supposed to do, and doing it as you feel confident and no hesitation. It's beautiful, 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 and I love it. Thank you for that, guys. Very good. So anyway, I just pasted the new conversion, and again, we're gonna be ready to do something similar into next week as we go. So it's 37 after the hour, which means that we got more or less 20 plus minutes to go ahead and find a new trade. Given what we said at the beginning of the session, obviously it would be nice to find another non-directional trade. But also, given the fact of what I said earlier, yes, to be honest, I was expecting the S&P to be a bit more negative, falling a bit harder, which is not the case. And the next red UFO is a bit far, to be honest. So again, we don't know if this climate is going to change or not. So I was tempted. Okay, and when I say tempted, it's just like talking about emotions and ignoring those emotions. I'm just saying it from an educational point of view, from a coaching point of view. If you wish, I was tempted to get into some short trades to demonstrate directional trading. I was tempted to do that. At the same time, if I do it, we are so close to the EMA. Next thing you know, we may have a close above the EMA. And if you think of my portfolio, which again, for educational purposes, I could totally ignore it. To be honest, I should. But at the same time, because I think like a trader, because I am a trader, because I cannot stop being a trader, so I cannot I cannot stop myself from thinking that Verizon is there, it's bullish, it's positive deltas, but I don't care it's there because you cannot lose anymore. So if I ignore Verizon, and Yelp is a mistake, it's there, you forget about it, that's an old trade. So if I forget about Verizon and Yelp, so then we got MasterCard, which is not doing well and is short, and Delta Airline, which is non-directional. So what happens if I put another short and now the market goes up? Well, if I put another short and the market goes up, I got two shorts, one which is already in pain, plus another short that may start gaining pain, with only one long, which basically already moved. towards the target. So I would be very, very imbalanced. So I'm not happy. If any, what you could do in a situation like today, since you expect the market to define itself and start moving in one direction or another, maybe you can find a long and a short and enter both. That could be one way to do it. But again, with what we saw earlier, I rather go ahead and find another non-directional trade, especially since I started already rolling my front wicks on Delta Airlines. I have no problem to add one more. So let's say, for example, I just entered, let's say yesterday, I entered a double calendar, which makes me non-directional, long Vega. And today I enter another non-directional, which is another double calendar, which makes me again non-directional, long Vega. So what's the problem? Well, the problem now is that I have so much positive Vega. So what if the VIX drops from 24 to lower? Right? So now what? My two trades are really not performing, right? So in other words, I don't like to do that in the same week, but because at that moment in time we already did the roll of the prior double calendar, so now we already started eliminating risk from the prior one, which already took care of some of the Vega from the prior trade, which we locked in already in the form of profit. So now I'm happy to add another one, and therefore this is going to be my choice from now until the end of the session. Let me know if my rationale makes sense to you guys, or you have another point of view. Again, not a problem if you have a different point of view, a different style, or a different preference. We are all traders. We all have our own trading plans, and we are all different beings, and therefore we trade differently. But at the same time, you know, I would say my rules probably are coming from a common sense point of view, and I'm curious to hear from you guys to understand if I'm making sense to you or you have other approaches so we can discuss it. Those are very interesting and rich conversations to have. So anyway, to build non-directional trades, I need to make sure that I got nothing in the stock filters. I got neutral on the daily, neutral on the weekly. So we got stocks that are trading with neutrality and therefore likely to remain neutral. We want earnings to, in this case, include a series of dates. I'm going to use the same that we got last week, which is all the way to July 16. Actually, I'm going to move 6/15 to one more week, okay, 6/22. Okay, so we don't have the front week too close. And then, yeah, and that would be all here. And then on the upper part, I need to make sure my options are cheap. So I'm going to start with advanced scan, implied volatility mean less than 20. So let's see if we got anything or we don't. Okay, and also I need to add my list. Okay, here we go. Okay, so with that type of filtering, which as you know, less than 20 is very demanding, we got nothing. What if we look at implied volatility mean minus historic below 2 standard deviation? That's another technique on how to look at cheap options. And again, we get nothing. What if we look at technique number 3, which normally gives us a result, which is top decrease in CIV mean in the last 5 days? This normally gives us something, and today, wow, interesting. This does not happen often, my friends. Makes me feel that maybe I got some check mark somewhere because it does not happen often, even though, of course, it could happen. Let me double check that. Earnings, we're including all earnings between 622 and 716. What if I go a bit further out and see? Yeah, nothing. So I am guessing that VIX 24 may be a bit high. Maybe a bit high because we don't have that. So I'm gonna work with the technicals, okay, with the daily neutral and the weekly neutral, and I'm gonna do something that I don't do often, which is to change this from daily to 2-day to see if I find neutrality, and I did find a couple. Okay, so this is the kind of like the trick to find some opportunities. Of course, it's better to find neutrality starting from daily to weekly because it's kind of like telling you that the price behavior of those stocks and therefore the sentiment at that moment in time, both in a daily basis or weekly basis, it's neutral. That increases greatly the probability of the stock to not to do too much, which is good when we are expecting a market to stay within a certain range, at least until we roll options for a few weeks before it starts moving. But we didn't find it. So I want to use 2 days, and I guess you are with me that if we look for neutrality on a 2-day time frame all the way to a weekly time frame, well, it's not a crazy thing to do, isn't it? It's not a crazy thing to do. So these setups make sense. Even if you didn't find anything, and then I did 2 day to 3 day, let's see if we got something, I would also accept that. And we have a few more. So I would also accept that. But ideally, the wider the range, in this case, from daily to weekly, in today's case, from 2 day to weekly, would also be accepted. Okay, and would be preferred. So let's begin with Twitter. Okay, let's take a look at Twitter. Okay, let's find out more about the earnings date. So the earnings date on Twitter is 7/28. So we could use expirations up to 7/22. Okay, up to 7/22. That would be the way to approach it. Okay. That's for the options that we sell. And for the options that we buy, we would want to buy July 29, because July 29 is the expiration date that will experience the greatest quantity of increase of implied volatility given the earnings report. So 7/29 will be the option strike that we're going to buy. Okay, for Twitter. So 7/29. So this is one that we're going to use. And then we could use any other strike less than 7/29 for the options that we sell. Okay. Now, which one are we going to use? And by the way, I really dislike this. Zero volume for all strikes. Wow. Other expiration dates are being traded, but that one is absolutely not, and the spread is crazy wide, where other expiration dates are very reasonable spreads with Twitter. So something's going on with that expiration date that has no volume at all. And you can see how some prices are changing, but still we got $1 spreads here. I'm just not going to be comfortable. So we're just going to move to Pfizer. Okay, we're going to move to Pfizer, which is our other opportunity. Not sure what's going on there. Obviously, there is a lot of talks going on with Twitter and Mr. Elon Musk and so on. So maybe it's related, maybe not, no idea. But the fact is that when you trade and you have no idea about something that is happening that doesn't look right, we just keep it. Okay, there are more stocks, so we don't need to force anything. So here's Pfizer. Okay, with Pfizer, we got a similar setup with earnings happening on 7/27. So again, we're going to use 7/29. So far, very similar situation. So let's look at July 29. Wow, and same thing here. What's going on with July 29? Why is it that we have so little volume traded? I mean, we got no volume traded at all. Oh, okay. I didn't change the symbol. This is so silly of me. Oh my God. Okay. I guess it'll be a funny one to remember. So same story with July 29 here. We got no trading that has happened, and we've been trading for a long time already, for over 2 hours since the market opened, and no trading has happened. The spreads are better here than before with Twitter, but really I'm so not comfortable here. Yeah, and plenty of trading on other expiration dates. I mean, I'm picking on purpose the July 15, which is a monthly expiration date. We know monthly expiration dates got more trading activity than the weekly, but still zero. That's very, very little. So I'm not going to be happy. And therefore, I'm going to be moving into my other combination, which was 2 days and 3 days, and see if other opportunities are better. So what else do we have? Okay, PayPal. Let's take a look at PayPal. PYPL. Let's go for it. So with PayPal, we got earnings happening right there, which is July 29, same story. So let's find out. PayPal, July 29. Okay, we got a little bit of, at least one strike there, got some trading going on. Okay, so the spreads are a little wide as well. Oh, wow. Yeah, again, we know that Weekly expiration dates are less liquid, but I'm a bit surprised here. PayPal is pretty nice in most cases. Look at that, 20-cent spread, very nice, but not on July 29, even though there've been some trading there. So I'm gonna look at another one, okay? And you can see I'm a bit pickier than normal today with liquidity conditions and things like that. And the reason is because we are entering a trade here that we will have to exit. This is not like an iron condor where, I mean, depending on where the price is, we may leave it alone and we let it expire. But an iron condor, you may be in a situation where you let it expire and that's it. This is not the case here. We're going to have to exit. So if there is lack of liquidity, that's a problem. And on top of that, we need to do multiple rolls. So if there is lack of liquidity every time, that's another problem. Of course, the rolls are happening with the front wick, which should be more liquid, but it's not a very good sign that expression day was so bad. So I prefer to explore other opportunities, and in this case, I'm going to check Blackstone and see what Blackstone has to offer. Let me see comments there. Joe, Elon makes an announcement and this could blow up. Yes, yes, indeed. But that would be a good thing. Okay, that would be a very good thing because these trades make money on volatility, right? So if the stock starts moving like crazy and rallies 50% or drops 50%, so yeah, you're going to be totally outside the range, but the increase of volatility may put you in a profitable position. And if this happens after a couple of rolls, a couple of weeks, next thing you know, you are in a nice profit. Okay, so this is not like an iron condor. Okay, and not sure if your question is coming from that thinking, but I remember when I started learning how to trade, and I spent lots of time doing around condors, and then one day I opened the door to other non-directional opportunities, which in this case were debit opportunities, like a double calendar. My mind was kind of stuck with the thinking that with an iron condor, you want the price to stay in the range for you to profit. With this trade, you also want the price to remain in a range, but only for a while, just to have an opportunity to roll a couple of times or three. Beyond that, actually, you don't want it to stay in a range. You would love it to really, really move. So then you can actually, profit from the increase of volatility as well as ideally selling options beyond your strikes, as we have done in certain cases in the past. Okay, so just remember that, Joe. Not sure if this was your thinking or not, but in any case, I think this is something that is it's good for me to remind everybody because again, we do many more iron condors compared to double calendars, so it's easy that our mindset goes back to that place. Okay. So anyway, so with Blackstone, we are dealing with the same thing with July 29. What's going on with July 29? So let's go ahead and take a look. Okay, and don't tell me that July 29 is not going to be good. Okay, so we had a little bit of trading there. Okay, but in this case, to be honest, I feel so much more comfortable. The spreads are so much more narrow. This seems much more like a friendly thing to me. Okay, and of course, if we look at July 15, it's going to be massive liquidity here. So I mean, and the other stocks were not bad. It's just that July 29 was a problem. So this one looks much less as a problem, even though of course the lack of volume is not ideal. Okay. Cool. Okay. So let's go for it. Okay. Let's start working on BX and see where we go. Let me float the option chain. So BX, if we're dealing with that expiration date, okay, given the current parameters of the trade, so we would expect a statistical range up to here on the upper part, okay, which is 138, and up to here in the bottom part, okay, which is like 70 something. Okay, so what do? We take the calculator and we divide this into three pieces. So if we take 138, and what did I say below? I said 71, I think. Yeah, more like 72. So 138 plus 72, that's 210 divided by 3, that's 70. So if I add that to 72, I get 142. Okay, so 142. Did I do the math correct? I cannot be. I'm not sure what I've done. 138 minus 72 divided by 3. 22. I'm not sure how I did the math. So plus 72, that's going to bring me to 94. Yes, that makes sense. So 94 is more or less here. Okay, so this is where I'm going to start. And the upper part, which is 138 minus 22, that's around 116. More or less here. Okay, something like that. Oh my God. Did you guys notice this? Did you guys notice that I'm like, this cannot be that my purple line is where my last candle is. That doesn't mean I'm in the center of the range. It's impossible. Did you guys notice that my cone, I guess that because of the prior trade was left in a prior date? Let me bring it to the current date so we can do the proper analysis. Sorry for that, guys. So anyway, so on this date, okay, we're going to be talking about being somewhere here, which is 142. And on that future date, we're going to be talking about being around here, which is around 87. Okay, so 87. Okay, here we go. So 87 and 142, that's the range. Okay, sorry for that. So 142 plus 87 minus 87, that's 55. So divided by 3, that's 18.3. So this below 142, that would be around 123.6. So let's go to 124. So we're going to be somewhere here. And then the bottom part is 87, right? Yes. So 87 plus that number 18, that's 105. So 105 is more or less here. Something like that. Okay, great. So now we have, this is correct now, right? So we have our upper third, our middle third, and our bottom third. Sorry for, getting, all mixed up there. So what do we have here? We got 125, we got 105. So 105 and 125. So those strikes should be available. So 125 call, sell the 125 call right there. And then we're gonna buy the 105 put and sell the 105 put. Okay, so this is what we're gonna do here. Okay, good. So with that in mind, let's go back to the option chain and see what the option chain will basically bring us if we do that, right? So we're gonna use one strike, we're gonna use the 105 and the 125. So these strikes are indeed available on that expiration date. This is good. And then if we add the front wick, June 17, so let's see what we get. Okay, let's see what we get. We have 40 something cents. Okay, so let's analyze this. So if I buy the 125 call and then I sell the 125 call using the front wick, and then I sell the 105 put using the front wick, and then I buy the 105 put using the front wick. Let me take a look. Buy and buy, call and put, sell and sell, call and put. This is correct. So this creates a trade with a risk of $600 something per contract. So this is a riskier trade compared to other trades that we have taken before. Okay. I'm not very happy about this. I believe we are not going to take this trade, my friends. Okay, so let me confirm that. I just want to look at the skew. It looks to me that we are not getting enough premium. Normally, I look at the skew before, isn't it? We're just looking at the time and trying to get this sorted. Okay, so where are we at? So the red line, let me maximize this. So the red line is the front wick, and it's paying very little. And all the other ones are so much lower, 45 versus 52. Um, the June 24 is right here. Yeah, yeah. I'm not convinced about these guys. I'm not seeing enough premium. Yeah. Notice how the one we are buying, which is June 24, 29. Let me do this so you will see more clearly what I'm trying to say. So the one that the one that we are buying, which is July 29, is the one in orange color. Notice how this option has implied volatility values higher than the ones that we are selling, right? You don't want that. I often use the term in prior sessions of having a pseudo arbitrage opportunity by having the front week options to surpass the implied volatility of the ones that you buy, but it's not the case in this case. Okay, especially on the put side, the puts are very high price. The put is the dotted line for this particular stock. So I'm not happy with what I see, and therefore we're gonna discard the trade because it would take many weeks to get to some improvement of risk, and at a rate of $50 per option, even with multiple weeks, we are not gonna get to remove the risk of the trade. Okay, so I'm just gonna pass, and we just reached the top of the session. So today is one of those days where we did the exercise just to conclude. No trade for us. It's obviously not ideal, but it's part of trading. Okay, so we're just gonna leave it here. The S&P is still doing its thing. Nothing new. Yeah, so we'll just leave it there, and I will see you next week, my friends. Keep up the good work. Again, very happy about those comments and in the chat box, and your trading activities. I'm just reviewing to see if there is anything I missed. I think it's all good. And again, keep up the good work, my friends. I will see you then. Okay. Bye bye, everybody. Take care.